Howdy, Jacob here. Another interesting company we're looking at from a price perspective with a lot of debt is ticker symbol CQP, also in the oil, gas, and consumable fuels. They provide natural gas to energy companies. So first thing I see, 15 billion in net debt with a 29.4 market cap, 44.5 enterprise value. Their price to book is negative because they have more liabilities than assets. Not the healthiest thing to see, especially in a market like this. 16 billion in debt with interest rates, going up on that long-term debt, where over here it was nearly nothing. That means a percent or two in interest rate could increase their expenses by 30 $320 million. I mean, that's a little bit of an impact over here. I mean, over here, right here, that's 25%. Over here, it's still a 7% impact on expenses. So, or that's way more than that. That's like a 14% impact. So, pretty big impact could be had through the expenses being increased from interest expense. They pay out 2.9 billion for their 6.7% yield. They've only been able to afford that 1 year. I think they're going to have to cut this at least in half. Like over here, they're not making anything. They're making a billion, 200 million, 800 million, 1.6 billion. I mean, that's everything. I'd almost say that I have to cut this into thirds, which would put this at a 2.2% yield. Um, I just don't see how confident I am in that. 416 sticking. Let's cut it by 3. And then what are some other assumptions? I mean, they've gone up like absolute wildfire here. They're making capital expenditures going down while their cash from operations going up. That's interesting to see here. I really dislike this debt. I mean, you never want more liabilities on hand than assets, especially in a high interest rate environment. Um, which I think, compared to the most recent 10 years pre-COVID and everything, I guess 2021 and prior for 13 years, it's almost been free debt, but now it's going to be costing a lot more, I think. I think there's no way that they keep this dividend. I mean, they will, because it sounds like over here they were making no money, still had $1.70 on dividends, which is why they increased their debt by so much. And now that they're making money, they luckily are actually buying back debt, which is good to see. But is it enough? Is it too late? I don't know. So 17 billion after all of this, I mean, I don't think that that's reasonable at all. But I'll just shoot 0, 10, 15 again. Let me increase this to 17.5 because the price to book being negative, so much debt on hand, I'm just not. It's gonna have to really blow my mind here, which, yeah, it's just gonna be tough to do. So let's look 16%, 11%. Let's try 14, 10. No change in shares. Yeah, we're not even close here. Which again, I put a lot of conservatism just from how much debt they have on hand, and I just don't think that they can afford paying so much in dividends, given that they can only afford it with 1 year of data at the past 10 years. So, um, Hope everyone has a good rest of their day, and thank you so much.